Welcome back to the Global Business Report. Trade tensions and fear of a global recession has been a drag on oil prices even during peak season for demand. In rapid succession, the central banks of India, New Zealand and Thailand cut interest rates on Wednesday as they scrambled to protect their economies and exports from the fallout from the US-China trade war. The rate cuts are a sign that the battle between Washington and Beijing poses threats to the global economy. Both gold and silver are trading higher in response to continued concerns that the trade war between the United States and China will get worse before it gets better and any sort of resolution is achieved. Still on the table is the initiation of new tariffs on the remaining $300 billion worth of Chinese imports sent to the United States to go in effect on the 1st of September. On these stories, research analyst Lukman Otunuga joins me now from London. Well, Otunuga, thank you very much for joining us. What can you, with regards to the oil prices that have dropped recently, can you explain the dynamics behind that?
Firstly, thank you for having me here today. It's always a pleasure. Yes, this week, all markets descended back into a bear market. Now, this is not the first time it's happened in 2019. The dynamics in all markets are changing. Rather than it being more supply side, it's more demand side. Fears over trade tensions between the two largest economies in the world have fueled concerns over a drop in demand for crude, and this is why we're seeing oil prices tumble across the board.
And do you sort of envisage more drops in the long run?
Yeah, so in the longer term, I'm quite negative on oil markets due to many geopolitical factors. Firstly, earlier in the week, we had reports from the United States which showed an expected rise in crude inventories. So it's showing that the demand is just not there. At the same time, although OPEC Plus are doing all they can to try to stabilize oil markets by cutting oil production by roughly 1.2 million barrels a day, we still have the big elephant in the room, which is US shale. US shale production remains at record levels. It's over 12 million barrels a day and is expected to rise further in 2020. Now, when we add the final key to the equation, the fact that major institutions such as the IMF, International Monetary Bank, IMF, have predicted global growth to decelerate to 3.2%, and the World Bank is predicting global growth to decelerate 2.6%. Energy consumption in large, emerging markets such as China, India, South Africa are likely to drop, and this is going to weigh negative on oil markets. So, medium to longer term, I'm bearish on oil prices.
And then let's quickly talk about gold prices. How is this affecting investor sentiments?
So, incredibly positive for gold since the start of the year. Since when the Federal Reserve was quite hawkish rather than dovish. And it was the Fed's policy U-turn at the end of January that made me reinforce my bullish outlook on gold. So if we look at gold year to date, gold has actually appreciated roughly 17%. Now, the last time gold has appreciated this much was back in 2020 when the year-to-date gains was roughly 30%. Now, the key themes that are driving gold prices higher are number one, trade tensions. Number two, concerns over slowing global growth. Number three, some bouts of dollar weakness. And finally, the fact that central banks across the globe are cutting interest rates. Now, it's widely known that gold tends to flourish in a low interest rate environment, and this is exactly the environment we're in right now. Yesterday, we saw 3 central banks cut interest rates, and altogether, could you believe a total of 37 central banks have cut interest rates in 2019, with 13 cutting interest rates more than once. So in such environments, of course, gold is likely to glitter with extreme intensity.
Now, earlier you mentioned, that gold has appreciated, but would you say prices have been stable there?
Yeah, looking at gold prices this week, prices blasted above the psychological 1,500. Now, today we can see a slight retracement with prices around 1,497 this morning when I entered. Right now, we're seeing something called a technical consolidation. The main themes that are keeping gold prices elevated still remain present. Gold bulls, as you say, are taking a slight tea break before going back on the offense sometime next week. Probably if we have further escalation of US-China trade tensions, more central banks joining the global easing bandwagon, or Donald Trump jumping on Twitter, tweeting something that rattles financial markets, this should push gold prices back above the 1,500 level.
And what would you say is the motivation for rate cuts at the moment?
Yeah, so the major motivation for rate cuts right now is a fear that something negative is going to happen across the global economy. Now, trade tensions have been going on for an extended period of time, and policymakers, different central banks are becoming extremely fearful that, a trade war between the two largest economies in the world presents a significant threat to global growth and stability. So what we're seeing right now is central banks, doing something we call an insurance rate cut, pulling a safety net in case things, spiral out of control.
And how can economies leverage on this?
Yeah, so this is very good news for emerging market economies, especially Nigeria, South Africa, and other emerging markets that have cut interest rates. When it's widely known that when a central bank lowers interest rates, this encourages borrowing, this reduces mortgage repayments, this reduces credit card repayments, this encourages corporations to borrow, this encourages corporations to invest, and it encourages banks to borrow to businesses and consumers. And it's widely known how consumption is a major driver of economic growth in many of these emerging markets. So lower rates, it's a way to stimulate economic growth.
And amidst the US-China trade row, how have markets fared?
As we can see, it's been chaos across financial markets. We've had extreme levels of volatility. It's been so much uncertainty. For example, let me give you what happened this week. At the start of the week, we saw the Chinese yuan weaken past the psychological 7 level. All of a sudden, there were fears of a trade wars descending to a currency war. US labeled China a currency manipulator. Stock markets across the globe crumbled. Now today, there seems to be a semblance of stability with stock markets pushing higher. So trade tensions are just creating uncertainty, volatility, and in times like this, investors are likely to keep a safe distance from risky assets and rush to bonds and safe haven investments such as the Japanese yen and, of course, gold.
Lukman Otunuga, thank you very much indeed.